Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to do the economy show. So because of the Martin Luther King holiday, the EIA show or the data that we use is pushed back to Thursday. So we're just going to flip it, which is, I think, timely if you think about what's happened with now Biden. It's now President Biden being, his inauguration was today. And going through what does he face coming in, what are some of the policies that he's already started to talk about, and then where do we sit with China and Asia, which has been a big focal point for us as we were leading up to this point. So again, we're going to break this into our normal 5 segments. The first one's going to have that global look. We're going to really kind of dig in again into grains, food security. What does that mean for inflation? And then obviously that high frequency data, mobility. What are we seeing on those new econ fronts? And then we're going to turn to the U.S. and we're going to outline what are some of Biden's stimulus plans. What does that mean for the dollar? And what to expect, in terms of what is the positioning that we have right now. Then we're going to go deeper into the U.S. consumer, some recent U.S. data points, wrap it up with Europe and then the emerging markets and what are some of the things that are happening there. And that, again, ties into the bigger picture of the U.S. dollar and the euro. And then in the last segment, we're going to do a deeper dive on Chinese data points, specifically GDP, some of the big drivers of that, and what do we expect to happen on a go-forward level. So just turning to and kicking off food insecurity, because this has been something, so we had several shows that were dedicated just to food, and I think this is an important one, again, not only because of inflation, but also just in terms of where is this money going to come from? If you look at the global backdrop of job losses, the pain of COVID, and what has that meant for the global economy, this is only going to get worse. And now the sub-Saharan Africa is facing another round of locusts that are coming from Ethiopia and Somalia, and Kenya has been impacted the most from that, just given, that they'll come from one side and then they don't really see borders. They're just going to fly and find food. And we've seen that coming up again in that sub-Sahara part. So when we look at some of the big impacts right now, sub-Saharan Africa, South Asia are the ones that are seeing an increase. And now, mind you, this is over the last 5 years. So this doesn't even include 2020, where we had another increase and another problem on food insecurity. And now 2021 is starting off very weak, just in terms of where prices are, what some of the crop numbers are showing, and really what do the crop numbers mean? We have flooding, we have droughts, based on those different capacities. Then we had bird flu coming through again, causing areas to cull flocks. And again, these are things that are just going to continue to lead to a rise in food insecurity. And unfortunately, North America, specifically the U.S., is not. It's still going to succumb to the same issues, and we're seeing that rise, as we've been talking about, where food insecurity is just getting worse and worse. And as insecurity grows, so does conflict, so does strife between neighbors. These are going to be things to watch as we go into a very difficult decade. And then when we look at the extreme poverty, again, when you have when the cost of food is going up, your poverty is going to also increase. There's going to be, because when you have less money to disperse, you have less money to spend on food as food prices go up. So then it becomes more expensive. So this is, I think, a big shift, and it started back in 2019, and it just accelerated through 2019, and now 2020 into 2021. We don't think this is going to get any better, and we're now. Should it be downside baseline? Again, this is going to be something that we're going to have to look at as we go through the year, as we go through plantings. Where is the flow going? How much nationalism is coming up? Russia has increased the export tariffs. They've started to put caps on what you're allowed to export. Again, these are small little things that are just going to adjust the global pool of food available. And again, by shrinking that, you're going to increase costs, which is only going to make extreme poverty that much worse. So again, this is going to be one of those fallouts that we continue to talk about. And now when we pivot a little bit, just looking at the U.S. in general, I think this is a very important chart. And this is one that we'll talk about multiple times when we start looking at bailouts. Why did 2008 happen the way it did? Why did we continue to kick this can? And the bigger issue is the shortfalls in pensions. And when you look at pension funds, I think this is a very interesting, and you can see the source here. I highly recommend reading it, looking at it. You can sign up to get 2 free articles. This is a very good one that really looks at the risk-free rate, because when you think about what pension funds are going to go to, they're going to look at the risk-free rate. So as the 10-year Treasury has gone in the 81 from 14% and continues to fall into this, let's call it 1.5%. Now you have this shortfall, which is the gap between the CalPERS discount. And just using CalPERS because it's large, it's thick, they're very open with some of their information. They need to go out there and find other investments to make up this gap, which is where we start to see people moving into riskier assets, moving into riskier instruments in order to try to make up this shortfall that, because when you think about a pension, you have a guaranteed rate of, let's call it 4 to 5%. You have a shrinking working pool, which we have a chart on, which we'll talk about it in a few segments from now. When you look at the shrinking pool, that means that you're going to have to make up that number with just, again, riskier investments. And that's where we continue to see them moving out of the risk-free rate of the 10-year Treasury into equities, into emerging market debt, into other, just increasing the exposure to potential risk. And again, these are things that are becoming a much bigger problem as we go through. How are they going to meet their number? Now, the Fed could raise rates. If they start raising rates, you could start seeing that risk-free rate going up. They're going to have natural buyers because they'll come back in, try to, again, buy up some of this new capacity. But you also they have to deliver this money. So do they just turn to their people and say, look, we promised you 4.5%, it's now 2%. And then what does that mean for the consumer? And this is where we have this push back and forth of, well, if pension funds are buying bonds of these risky companies, which is why we can't let those companies go bankrupt, AKA zombie companies, didn't you know the risk? And they're going to sit there and say, yes, we did, but we had no choice, or something along those lines, which again, pensions become a much bigger part of the problem versus the solution as they continue to be underfunded, as their costs continue to rise. And this is going to be something to watch and something that we're going to talk about as we continue through a very challenging point where we have very low rates for an extended period of time, rising costs with inflation. And what does that mean as these individuals who are collecting the pension need a increase to their payments because their costs are going up? And how is that going to put additional pressure on some of these pension funds? And rounding out on inflation, pensions, food security, let's just look at agriculture commodity prices. And as we've been talking about, and as we got very adamant in March and April, where we said, look, this is going to be a huge move higher just given the amount of demand in the market and shortfall in supply. And here is just looking at those commodity prices adjusted to January, and you can see just the rampant moves. And again, this links back to inflation, cost, pain and strife that is hitting some of these areas that just don't have the same type of capital. Now, not only is there commodity price issues, but when we look at national single family rent index, year over year percent change on per price tier. So regardless if you're low tier, low middle tier, high middle tier, high tier, it's going up. And we're now converging on this 4%, and again, this comes back to what is hitting people's wallets the most. And in the next segment, we're going to have a breakdown of some of those year over year price changes that are going to continue to hit. Now, as we see this pain, as we see these problems, what does that mean? Well, let's look at 2020 global defaults. Well, the year, it's below 2009, so that's a slight benefit, but we also had a massive amount of stimulus coming in the way of small business loans, other types of loans from developed markets, emerging markets. So even with that support, we still had a huge default number. And it's important to look at the U.S., more so than some of the others, because we just saw a bigger decline because, again, retail, energy, we had some consolidation that was long overdue. And COVID was kind of that means or the push to finally see that consolidation. we're already starting off 2021 with some problems in Europe. As we go a little bit further, we're going to talk about some additional bankruptcies in the U.S. But again, this is going to be one to watch. In emerging markets is the pain that we think it could surprise to the upside, especially as they continue to try to roll their debt. They're issuing more debt, which we'll talk about in the fourth segment. And again, these are going to be some of those issues in terms of, well, what is this overhang on the global economy as we try to get back to some sort of normalcy? And the U.S. recovery tracker, we're rolling over and we're not seeing this normal bounce. And when I say that normal bounce, so January is always slow. So to see a slower January isn't really a huge surprise, but to see it not getting back to already weak levels is the bigger concern as we continue to see some of the slowdown permeate throughout the system, and not just in the U.S., which again is going to be the problem, because when we look at demand, employment, financial mobility, all of it's essentially a continuation. And not to say that we're going to go back to March and April lows, but this is where we keep coming to. We're just seeing this flattening out at a very reduced rate, which again is going to be that bigger issue on how do we stimulate and really grow the economy and cover some of this huge amount of debt that we're just pushing into the system. And we're not the only ones. And that's the bigger conundrum, because when we look at emerging markets, you can see that they've settled out at that lower level of just below 80 and not getting to that December pop. Chile is talking about how they're going to have copper supply that's going to be impacted as long as COVID remains a bigger issue. And we're seeing some of these shortfalls on supply, which is driving up these prices because demand isn't going anywhere. If anything, it's increasing based on infrastructure spending. So you're getting a demand surge, you're getting speculation in that demand, and you don't have the supply to meet it. So that's when you get these huge gaps. And we're going to talk about rebar in the fifth segment, specifically in China, which is where we continue to see that slowdown in China, which we'll talk about in more detail. But it's important to appreciate that they're seeing their own increase in COVID. Beijing saw another spike of cases, and by spike, they're talking 6. Is it 6? Is it 60? Is it 600? Again, this is what we don't really know, but we do know how they're going to react, and it's going to be a huge lockdown. We saw them weld people in, limit movements, and this is coming ahead of the largest migration in essentially in the world. So every year, Lunar New Year, you have people going from the urban setting into their rural home for 20 to 30 days to celebrate the new year. And the problem is a lot of these spreads are happening in the rural setting, which obviously is harder to track, harder to find, people more spread out. So that's why we think we're going to see this big slowdown, and we're not going to see the migration very similar to what happened in the first quarter of 2020, when we just didn't have that migration. This is going to impact demand. By impacting demand, that's going to bleed down into some of the other areas as they purchase a lot of stuff from emerging markets. And again, the advanced economies, you can see that drop off as we went from, let's call it 70 to 60 on the holiday, and we're still not getting back to where we were. Where, if anything, we're starting to roll over as we're getting new announcements of lockdowns. France has talked about keeping everything shut, specifically restaurants and stores, until April. We saw Germany talking about finding ways to extend. UK no different. US is facing a similar hurdle. Again, these are things that are going to continue to weigh, because advanced economies purchase from emerging markets and raw materials. And again, this is the economy that we see, not the one that's priced in right now, because that is something very different. But this is the underlying economy. And there's really no one that's shaking off this slowdown. Now that we look at some of the emerging markets, the ones that we look at the most is India, which has seen a steady grind higher. And we'll talk about that in the last segment, because India remains that bright spot of, okay, well, how quickly are we seeing this rise? When are they going to start to see a bigger movement, or are they going to follow this trend lower? Because we didn't see the spread of COVID from Diwali, which is a very good thing, which means that they're seeing some benefit. But as some of their biggest trade partners slow down, how is that going to weigh? And we're already seeing those issues on the import-export side and industrial production. And this is the example of all those daily indicators looking at the developed markets where, Japan bounced and it has really started to come back off as they face their own spread, which we'll focus more on in the last segment. And then again, you can see the UK, you can see the US, Germany, all of these remain well below this growth level that we need to see to get some sort of normalcy and some sort of growth back into the underlying economy. So when we look at those restrictions, this is the government response index, and this is just looking at what's happened in Europe. And this is the snapback where you can see France started to come back down, but now they're going to kind of hold at this level now that they've extended their restaurant and store declines. But Germany has been holding strong. Spain has started to loosen up. But when we look at the Netherlands, Italy, and Germany, they continue to toe that line of maximum lockdowns to try to mitigate some of the spread that continues to permeate throughout the system, with Germany actually strengthening some of their demands and rules and laws for mask wearing to try to find some way to get past this sticky point, because they're past the peak, but they're not back to their target. They're kind of stuck in this level, and it comes down to how does the populace have a buy-in on the renewed lockdowns? Are they trying to go about their day normally? And this is where we continue to see this push and pull from the government side, and then people and the underlying population. And again, coming to the consumer, because we saw some bright spots in some of the European data, which we talked about last week. But when we look at retail sales, travel, leisure, these continue to weaken and continue to move lower, especially in Germany, which when we look at France had really weak retail sales, even though they had a little bit of a bounce, which just means that for us, Germany, Netherlands, Italy are going to continue to see something very similar, especially now that Germany is back with the VAT tax. People pulled forward some of their purchases to make sure it happened in 2020 before the adjustment in taxes. And again, these are things that are going to continue to weigh on. And why do we talk about Europe so much? It's the euro and US dollar. And where is that going to go? And that's something that we're going to cover very specifically in the second segment. And then when we look at, again, the German consumer, the holdback on spending in most areas, again, except groceries. And groceries is where we're seeing a huge increase in prices. Europe alone is seeing an increase of 4 to 7%, depending on the product. But yet they have a negative CPI. And that's why we keep coming back to, well, we have to look at where are people spending. And Germany is no different, because when we look at groceries, you can see that it's well up. Furniture, something similar, but clothing, fuel service stations, hospitality, airlines, all of those things that nobody is currently purchasing or purchasing much less of, is showing that negative move and that percent change in transactions, which is giving this perception of a reduced CPI, but it's for what people are buying day in and day out, there is an increase, and it's only going higher. Back to where we talked about food security, food prices, what's happening in the global market on the commodity side. And that's where we look at that Eurozone consumer confidence continues to move low, and the U.S. is not alone. Europe isn't alone. Eurozone isn't alone, where there is just a continuation of fear when we look at what is the consumer's confidence and why is that important is, well, how quickly will they snap back post-COVID? Do they have the money to snap back once there's some sort of normalcy in the market? And these are things that we continue to see as headwinds throughout the recovery process, even as the U.S. market is at all-time highs. NASDAQ is at all-time highs, but again, we just have to weigh the different things because we have central bank governments' bond holdings. You can see the huge explosion of purchases across the board, Fed, ECB, BOJ. Everybody has increased their purchases, with obviously the three being the largest, the BOE, something similar, and this is continuing to go higher. This will not stop in 2021. We've highlighted in other shows just the percentage that we're going to continue to see. The U.S. is going to maintain that 120 billion a month purchasing, which again is going to keep shifting those bond holdings higher. And well, what does that mean? Well, where is the money? Where's the inflation? How is this moving through the system? And these are things that we've covered in other shows, and we'll rehash again in the second segment as we go a little bit deeper into inflation. And then with after the sharp rebound in the PMI, which we've been highlighting as some of that leading indicators, even the leading indicators were showing some strain or some numbers that were artificially higher because of supply chain issues. And even though that we've seen those increases, they're starting to roll back over. And it's not just in Europe, as we've highlighted in the US with those supply chain disruptions. And that's why when we look at that mobility, when we look at the aggregate of where we sit, not only just on the high frequency data, because that's looking at other components, but this is looking at people moving about. This is gasoline demand. This is jet fuel demand. This is diesel demand for some of those trains and some of the other means of people moving about their daily lives, and we're just not seeing that recovery. Mobility remains an overarching problem coming into what we're going to talk about in the EIA show, segment 2, looking at, okay, well, what are some of the high frequency mobility data points saying? And then this is that trend. This is trying to move an aircraft carrier, and it's still not moving, and it's still very slow, and we're still holding at these, let's call it these May, June levels. And we obviously there's weather involved. Do you want to do as much when it's cold out? The answer is no. So not only do we have the impacts of COVID and people not feeling great about their situation, but we also have just the underlying, it's cold out, I want to stay home, I don't want to increase exposure. And these are headwinds that we continue to see on the demand side, which we'll talk about more tomorrow in the EIA show. But now in the next segment, we get to talk about, well, what is happening in the world today? And just to give some color before we switch over, you can see the Goldman Sachs non-profitable technology index and just the levels it's at. I mean, if you didn't laugh, you'd cry, I guess. Or if you're long, congratulations. I know that it's a matter of catching and riding the wave. But just remember, it's always smart to take profits. Nobody's ever gone broke taking a profit. And this is going to be something that, not to say it has to correct fully back to the lows, but this is something to consider of, can all of these companies actually grow into their earnings, or is there going to have to be some sort of correction between the two as we get some of this strife back and forth? So again, these are going to be some interesting points as we turn to the next segment. We're going to kick off with what are some of Biden's stimulus plans as he enters office.